In the previous videos, we introduced absolute valuation method and also relative valuation method, and we also discussed in detail regarding dividend discount model. We did introduce one important element of growth. For example, in dividend discount model, we said that there is a growth element on dividend. This growth element is related with dividend growth, and this really determines the value of a company. The formula in a multi-stage dividend discount model, the first-year dividend will be the current dividend multiplied by 1 plus G, and then divided by 1 plus cost of equity. This will continue for the next year. Second year it will be D1 multiplied by 1 plus G, and then divided by 1 plus R raised to power 2 and so on. So, G is a growth rate in dividends or earnings. So in this section, we'll spend some time understanding what really defines growth and how we can determine it. The idea behind this exercise is that the capital structure is not changing, and there is no new equity issued. If there is new equity issued, then the capital structure will change, which can have a direct impact on the growth on earning or dividend. As an example, if the debt is more in a company, this will lead to a higher interest rate payment. A higher interest rate payment will cause decline in the amount available to distribute as dividend. The basic formula of sustainable growth rate is retention rate multiplied by return on equity. Retention rate is defined as 1 minus dividend payout rate. Let us say dividend payout rate is 40%. This means whatever the company is earning, 40% is paid out to the equity owners as dividend. Company is keeping 1 minus 40%, which is 60% of the earning for future growth. Now, when we multiply this with return on equity, we get growth. How do we define return on equity? Return on equity is net income by sales multiplied by sales by assets multiplied by assets by equity. First part would represent profitability. Second part will represent a turnover. And the last part represents leverage. Let's look at this in details. ROE is margin, that is net income divided by sales. This is nothing but margin. This multiplied by sales divided by total assets. This represents turnover, and then this is multiplied by assets divided by equity. If you look carefully, most of things are getting canceled, and we are left with net income divided by equity, which represents equity return, or in other words, return on equity or ROE. So, we can see that ROE is equal to net income divided by sales multiplied by sales, then divided by assets, then multiplied by assets, and divided by equity. These all cancel, and we are left with net income divided by equity. So, the growth is ROE multiplied by retention rate, where retention rate is nothing but 1 minus dividend payout ratio. So, if we adjust everything, we are left with net income minus dividend divided by equity, and this would represent a growth. Let's say we have net income as $100. So, we are left with $60 as 40% is the dividend payout ratio. So, 60 divided by 100, which is 60%, is our retention rate. These relationships are mainly divided into two major factors which are impacting the performance or the growth of dividend or earnings, and these are primarily divided into the financial performance and the leverage of a company. The leverage of a company represents financing decisions of a company. The rest represents performance of the company. This means that the growth of a company would be dependent upon how a company is financing its operations and also the performance. The financing decision is divided through the retention ratio and through asset divided by equity, which indicates the leverage in the company, and net income divided by sales is margin, and asset turnover explains how efficiently assets are being utilized. This would represent the performance of a company. With this in mind, we will solve a few questions on sustainable growth rate in the next video.